An investor's natural tendency is to follow the crowd, so they couldn't give the impression that they knew a lot about a certain investment. However, it is more likely to veer off the herd's course. This behavior is called herd mentality. People frequently invest their money in the stock market to increase their fortune. The stock market is frequently thought of as a mechanism for people and businesses to make money by buying and selling shares in publicly traded businesses. The average investor may not always be able to see the stock market's darker side though. Influential organizations need large sums of money, not available to individuals, to finish large stock market projects. People can invest money in businesses and then use it to finance creative projects. The investor then becomes a shareholder in the business. The investor gets a share of the company's future profits, and if the company loses money, the investor is responsible for covering the loss. Welcome back to Finance Professor channel, where we teach everyone about personal finance and how to build generational wealth. In today's video, we will discuss the darker side of the stock market. Don't forget to subscribe to our channel. Now, let's dive in. A great approach to building wealth is through the stock market, no doubt. Many wealthy investors from the US, India, and other countries account for having made their wealth on the stock market. However, most successful investors and analysts ignore many unfavorable facts about the stock market. Even the bluest of blue chips can underperform and not make any money over a long period of time. Any stock you invest in entails a risk, regardless of its security. The value of a company's stock can be affected by countless variables. For instance, local or global economies, industries, business fundamentals, technological issues, new laws, taxes, and social and political risks, just to mention a few, may affect your investment. If someone assures you of a certain return, they are either dishonest or inexperienced. The best thing you can do when trading stocks is to lower risk by making deliberate, informed decisions. Participants in the stock market are prone to giving in to greed and fear. When everything is going well, a robust economy, high employment, the government enacting beneficial policies, etc., people become overconfident and greedy. We all want to amass as much wealth as possible in as little as time as possible. Stock prices are mispriced as a result. Due to the investor's strong desire, it can be hard to stick to the basics and keep a long-term strategy. People tend to become too defensive when conditions are bad. The economy isn't doing well, and the market has been losing money for a while. Most stock investors' decisions are driven by the market, which is dominated by greed and fear. Although most gurus will argue otherwise, managing your greed and fear when making an investment decision can be difficult. Executives at companies can manipulate their profits. One of the terrible truths of the stock market is this: everyone wants to invest money in a company that is expanding quickly. What could be a more reliable sign of development than consistently rising firm profits? When the market starts to count on the company to provide outstanding results every quarter, it puts a lot of pressure on management to keep its word. They might falsify their findings to keep their stock price from falling if they don't. Numerous businesses have been found guilty of fabricating financial records. Most customers spend too much on a popular item and lose money when the store loses its appeal. Even when earnings are not growing commensurately, many companies trade at a valuation far above their price-to-earnings ratio. People often pay too much for premium stocks, which is a bad thing about the stock market. Think about that. Almost all stock market investors are in the same situation. They buy stocks without investigation, which results in overpaying for them. This is the unpleasant truth about the stock market. Not everyone makes money on the stock market. According to common estimates, nearly 90% of investors experience a financial loss. This isn't a result of the market not treating people fairly. This is so because most individuals would rather invest time or effort. Most buyers will select option B over option A when given the option to invest in a stock recommended by a friend or to diligently research a company. The stock market does, however, include some hazards. One of the best known instances of the dark side of the stock market is insider trading. This occurs when a person buys or sells stock ahead of time based on inside knowledge about a company's financial performance or upcoming events. This can offer those insiders an unfair edge over other investors and is against the law. If a company executive knows that the company is about to announce a big merger or acquisition, they might buy the stock before making an announcement. The executive can sell the stock at a better price after the announcement, because the stock price will probably increase. This is unlawful, and if the executive is found doing it, they could face fines, penalties, and possibly jail time. Financial report manipulation illustrates the stock market's evil side. This can happen when a business tells lies about its finances to make it look more successful than it really is. This may cause investors to base their selections on inaccurate information. For instance, a business might exaggerate earnings or revenue to satisfy Wall Street demands. This may cause investors to purchase stock in the company under the impression that it is doing well when in fact it is not. This is also against the law, and people who do it could face fines, penalties, or even jail time. Another significant problem in the stock market is fraud. This may occur when a business or someone makes false claims or withholds information to entice investors to purchase stock in a business that is less profitable than it seems. For example, a business can lie about having a new product or technology in order to get investors interested. As a result, investors may purchase stock in the company under the impression that it is set to soar, while this is not the case. This is also against the law, and people who do it could face fines, penalties, or even jail time. Investors should be aware of these practices and do a lot of research before buying any stock. To stop such tactics in the stock market, regulatory organizations like the Securities and Exchange Commission or SEC also work to enforce laws and regulations. When making stock market investments, it's crucial to remain cautious and study extensively. This will help you spot any red flags and keep you from doing anything unethical or illegal. Don't get me wrong, recall that investing in stocks can be a fantastic method to increase your wealth. But it's crucial to be aware of the risks and take precautions against the dark side of the stock market. If a disaster like the one in 2008 happens again, top economists who are always guessing about whether the economy is growing or shrinking will fail to see it coming. Financial advice is given by advisors based on the information they have and their own experience. You are delusory if you believe they can predict the future. If they can, they are duped. You are ready to witness many unexpected things when you enter the stock market. Nobody can foresee the future. The investors have never visited the business and are unfamiliar with the current circumstances. Only the company's workers are aware of the company's periodically subpar performance. Big businesses benefit from a rigged stock market at the expense of regular people. For an investor, herd mentality is optional, not required. In addition to the business motivation, other factors should be considered. That is all for this video. We will be back soon with another informative video. What has been your experience on the stock market? Comment down below. Don't forget to like and share this video.